Hello friends, welcome to MarketMindsetAI. I am Amber from Singapore. Today I am going to tell you what the stock market is really about, the things nobody tells you. And I am telling you from 20 years of real experience. Let us get started. Look at this chart. This is the S&P 500. And if there is one chart in investing you need to understand, this is it. I have been in this market for 20 years. And today I am going to tell you everything that nobody tells you straight. So whom this video is for? Beginners, people who have heard about investing but are still confused, and people who have been investing for a year or two but feel uncertain. So what they will get? The real mistakes that cost people money, a simple framework that actually works, and what you can personally do with your own money. Myth number 1. The market always goes up. In long run, yes. But in short run, it can wipe out your confidence, your money, and your discipline if you do not understand what you are looking at. Facts are: .com crash 2000 to 2002. S&P 500 dropped 49%. $1,000 became $500. Recovery took 15 years. 2008 financial crisis. S&P 500 dropped 57%. COVID 2020. S&P 500 down 34% in just 1 month. The point is not to scare you, but go in with your eyes open. This is not easy money. It is patient money. I have spent 20 years trying to time this market. The honest truth is, nobody can do it consistently. Not hedge funds, not people with MBAs, not anyone on Wall Street. If you miss just the best 10 days in 20 years, your return gets cut in half. That is how badly timing the market can hurt you. Time and the market beats timing the market. This is not just a saying. It is what the data shows, year after year. Third misconception. You need a lot of money to invest. You don't. Today, you can start with literally $10 or $50 through fractional shares. The amount matters less than the habit. Starting early and staying consistent is more powerful than starting with a big lump sum late. Look at this simple chart. One person invested $10 every month and another person invested $500. The $10 person invested 6 times less money and still won. That is what starting early does. That is compounding. A stock is a small piece of ownership in a company. For example, if you buy 1 share of Microsoft share, you own a tiny fraction of Microsoft. If Microsoft grows, your share price goes up. If Microsoft struggles, your share price goes down. The problem with individual stocks is, one company can fail completely, and picking winning stocks consistently is genuinely hard. Even professional fund managers fail to beat the market more than half the time over 15 years. This is not opinion, this is data. Let me show you exactly what an ETF is. One picture, 30 seconds. You will never forget it. This box on the left, this is VOO, the Vanguard S&P 500 ETF, one of the most popular investments in the world. When you buy VOO, you are buying Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla, Berkshire, and 492 more companies, all in one single purchase. VOO tracks the S&P 500, the 500 biggest companies in America, 500 companies, in one fund. Annual fee, just 0.03%. On $10,000, that is $3 a year. $3. Historical average return, 12 to 13% per year. Buy one ETF. Own 500 companies instantly. And here is the key point. One ETF gives you 500 companies at once. If one company goes bankrupt, it barely affects you. That is the power of diversification. Professional trading required lots of time and energy to study a technical chart, but mind it. As an investor, the 2 important parameters you need to concentrate is support and resistance. Let's understand this. Support level. The price where a stock keeps stopping its fall and bouncing back. Think of it as a floor. Buyers keep defending that level. Resistance level. The price where a stock keeps stopping its rise and pulling back. Think of it as a ceiling. Sellers keep dominating there. To conclude, stock breaks above resistance with strong volume equal sign bullish signal. Stock breaks below support equal sign potential for more downside. Remember, charts are not a guarantee. They give you context. They help you make informed decisions instead of emotional ones. That is the goal. Now let us talk about the mistakes people do in stock market. These are real. I have watched them happen. Real people, real money lost. When market crashes, everyone panic sells. When market rises, everyone rushes to buy. Both are the wrong time. The market takes money from emotional investors and gives it to patient, disciplined ones. I have watched this happen again and again. In 2008, 2020, 2022, every single crash, the people who sold at the bottom lost money. The people who stayed invested or kept buying, they made money. Mistake number 2. No plan. Most people buy a stock or an ETF with no clear idea of why they bought it, how long they plan to hold, or when they would sell. That is not investing. That is gambling. Before you put 1 rupee into anything, answer 3 questions. Why am I buying this? How long am I holding? What would make me sell? Simone told you about a stock, saw it trending on social media. A news headline said this sector is going to explode. By the time a tip reaches you, the people who actually knew about it have already made their money and are getting out. You are buying their exit. Mistake number 4. Ignoring fees. This looks small, but over decades it is enormous. Active fund at 1% fee versus ETF at 0.05% fees. Sounds like nothing. But on 10 lakh rupees over 30 years, that difference is lakhs of rupees lost to fees. Mistake number 5. No diversification. Putting 80 or 90% of your money into one stock, one sector, or one asset class. In 2000, everyone was investing in tech sector and later Nasdaq dropped 75%. In 2022, everyone was in crypto and later Bitcoin dropped 75%. Diversification is not exciting, but it is the closest thing to reduce risk that exists in investing. Now this is the most important section. Think of your portfolio in 2 parts. The core, 70 to 80%. This is boring, broad, diversified. Invest in ETFs like VOO or VTI. This is the engine of your long-term wealth. The satellite, 20 to 30%. This is where you can take more calculated risk. You can invest in individual stocks or sector ETFs, things you genuinely believe in for the long term. This part keeps investing interesting. But it should never be the majority of your money. Believe me, most people do it backwards. They put 80% in risky bets and 20% in safe investments. It should be the opposite. What is dollar cost averaging? This simply means investing a fixed amount every single month, whether the market is up, down, or sideways. You do not try to time it. You do not wait for the right moment. You just invest consistently every month. When the market is down, your fixed amount buys more shares. When it is up, it buys fewer. Over time, your average purchase price balances out, and you remove the biggest enemy of the individual investor, the urge to time the market. The fact is, $500 a month invested consistently from age 25 to 65 at historical average returns grows to over $1 million. That's not a get-rich-quick scheme. That's patience and discipline doing the work. So friends, let us wrap up this video quickly. What we learned: crashes, recovery, new highs, 3 myths, the basics, 5 mistakes to avoid, 1 simple framework to follow. This is my 20 years learning in 10 minutes for you. Keep investing. Do drop a comment. Tell me one thing you learned today or ask me your biggest question. I read every single one. If today's video helped you, hit subscribe. It is free. Next video: VO versus VTI versus QQQ. Full comparison, real numbers, and I tell you exactly what I personally hold. See you in the next one.